Hello and welcome to our video on financial ratios. In this video, we will explain the importance of financial ratios and how to use them to check the financial health of a company. What are financial ratios? Financial ratios are mathematical calculations that are used to analyze the financial health of a company. They are important because they help investors, analysts, and business owners make informed decisions about the financial health and profitability of a company. Current ratio. One of the most commonly used ratios is the current ratio, which measures a company's ability to pay its short-term debts. For example, if a company has a current ratio of 2 to 1, this means that it has twice as many current assets as it does current liabilities. Let's take the example of a fictitious company called ABC Corporation. ABC Corp has current assets of $100,000 and current liabilities of $50,000. This means that ABC Corp has a current ratio of 2 to 1, which indicates that the company is able to pay its short-term debts. Current liabilities net worth. Another important ratio is the current liabilities net worth ratio, which measures the proportion of a company's current liabilities to its net worth. For example, if a company has a current liabilities net worth ratio of 0.5 to 1, this means that its current liabilities are half of its net worth. Let's take the example of a fictitious company called XYZ Incorporated. XYZ Incorporated has current liabilities of $50,000 and a net worth of $100,000. This means that XYZ Incorporated has a current liabilities net worth ratio of 0.5 to 1, which indicates that the company has a low level of debt. Fixed assets to net worth ratio. The fixed assets to net worth ratio measures the proportion of a company's fixed assets to its net worth. For example, if a company has a fixed assets to net worth ratio of 0.4 to 1, this means that its fixed assets are 40% of its net worth. Let's take the example of a fictitious company called LMN Corporation. LMN Corp has fixed assets of $200,000 and a net worth of $500,000. This means that LMN Corp has a fixed assets to net worth ratio of 0.4 to 1, which indicates that the company has a substantial amount of fixed assets in comparison to its net worth. Debt ratio. The debt ratio measures the proportion of a company's assets that are financed by debt. For example, if a company has a debt ratio of 0.4 to 1, this means that its debt is 40% of its total assets. Let's take the example of a fictitious company called PQR Incorporated. PQR Incorporated has total debt of $200,000 and total assets of $500,000. This means that PQR Incorporated has a debt ratio of 0.4 to 1, which indicates that the company has a moderate level of debt. Net profit on net sales. The net profit on net sales ratio measures a company's profitability by calculating the percentage of net profit to net sales. For example, if a company has a net profit on net sales ratio of 10%, this means that it earns 10 cents of net profit for every dollar of net sales. Let's take the example of a fictitious company called RST Corporation. RST Corp has net profit of $50,000 and net sales of $500,000. This means that RST Corp has a net profit on net sales ratio of 10%, which indicates that the company is earning a healthy profit from its sales. A high net profit on net sales ratio is desirable as it shows that the company is efficient at converting its sales into profits. In conclusion, financial ratios are crucial tools for evaluating the financial health and profitability of a company. By understanding the different ratios and their applications, you can make informed decisions about investments, financial planning, and business operations. Thank you for watching the L&A Accounting channel. If you found this video helpful, please subscribe to our channel and hit the notification bell to stay updated on our future videos. See you in the next one.